If you haven't done this before, I'm Tim Quast. Nice to have you here. This is your time. I'll do my very best to help you use the platform effectively. That's the whole idea. 2 rules are ask lots of questions, mute yourself while we're talking, just so there's no background noise, and that's really it. And I've got, as usual, 4 or 5 things that I'd like to cover, 5 technically. I thought I would share with you, and I'm not sure you care, but I'll share it with you because it just got off this webinar, and it was a NASDAQ hosted webinar about these 4 SEC rule proposals, which could change the market rather significantly. So I think it's important for traders to know. You should know, well, what is the SEC contemplating? And I could summarize. I'll tell you, it was, even for a guy like me who likes to wade through dense regulatory documents, and if you add up Regulation National Market System, roughly 523 or 4 pages. There's what's called the Market Data Infrastructure Plan, which is a corollary to Reg NMS. That's the regulation that governs. That is why the stock market works the way it does. So the MDIP, Market Data Infrastructure Plan, 595 pages. Now they've proposed 4 separate new rules that comprise 1,650 pages, and they're all designed, in effect, to push more trading onto the exchanges. And here's what I mean by that. I'm going to show you a couple of things. Why would you care? Well, because right now, pretty easy to trade in 99 share increments. I talk about that. You don't have to do it. You can use an algorithm. There are reasons why I do this. So this is my, I trade on Interactive Brokers, and I don't like to have positions during options expirations per se, but I do. And I generally buy this very same stuff I talk about all the time. And I want to show you these trades because I think it's important. So you see, I trade 50,000, something like that. So not a lot there. Let me let everybody in. And I want to so I pay commission so I can track my trades. I'd like to know where they occur. So over here, I can go back and look at my orders and trades and see how and where and why they executed. So I bought, ANET, which was the best today. I looked at it, so okay, well, I'm buying that, and I'm still in it. Do I want to take gains? Yes, I do. There's not a lot because I don't own very much. I bought 99 shares. Where did it execute? It executed in my own broker's alternatives trading system. What that means is I put the trade in at the market at 141.85. I took the best price available, knowing that in the worst case, my own broker is going to have to buy it from me. That's the law. Sometimes they can send it out to somebody else. So when I bought KO, it traded at Island. This was yesterday. And look, it's split into 2 trades. I put in 99 shares. I got 59.45 on both of them. But see this? I paid a commission on one, not on the other. There's my commission, $1. It's worth it to me because I can go look and see where things are trading. Island is Instinet. It's an electronic communications network. Island goes a long way back, but they bought the technology. DART means it executed in a broker pool. I want to show you how many trades occur at exchanges. Not very many. And that's why these proposals are occurring. So if you look at the data here, all the way down through these trades that I've done, you have to go all the way down here to when I bought, I own a fair amount of Coke, and I bought it at IEX, 60.28. And it's, that's not a great price, but I have added to it, brought my cost basis down. There's the first trade at an exchange. They've only got about 2.5% of the market. Then there's an NYSE trade here, PCG, 1562. Tends to be my worst prices are on the exchanges. Routinely, I get better prices in dark pools, and you will see that they'll be to the 10th of a penny, sometimes to the 100th of a penny. If I think there are a couple down here. I don't see them right at the moment. I pay attention to this. Here's one. So it's a small hedge. I use a small. I'll tell you why. I want to show you this too because I think it's informative to understand how the market works. I'm beginning to experiment with this. I'll talk more about it once I know something. But I think that it's important to have a hedge. SH is an inverse S&P 500 ETF. I apologize. I wish I could fix this problem so that I can do this once and everybody's admitted, and I haven't figured it out yet. So any of you IT experts, let me know. I've got IT people, I just don't think to ask beforehand. So that's interesting. If you look at the entire list, there are 3 trades, 1, 2, 3 out of the last week-ish or so, where there are maybe 35, 40 trades that I've done that have executed at exchanges. So all these other trades are executing at broker-operated pools, or a broker itself is buying or selling a trade. And these proposals, by and large, are designed to try to move some of that market share back to an exchange. Is that good or bad? Well, to me, the worst execution occurs on the exchanges. I don't like anything about the way the market works, except that it's pretty easy to get a trade done and it's very inexpensive. But that is the real point. That the regulators would like to see trades move on to the stock exchanges more, and they want to shift quotes which currently occur in pennies. You can only quote in pennies, penny increments, but a lot of trades occur at sub-penny increments. So now they want to institute sub-penny quotes. The thinking is now the quotes and trades will be unified. Well, but it just gives more opportunity to the Citadels of the world to change the price in tiny little increments. Does that matter to us? Not really, but it means that the market direction will become even harder to determine. The narrower the spread, the shorter the time horizon. You have a 5-cent spread, you're unlikely to sell it in 300 milliseconds. If you have a tenth of a spread, you do. And I want to show you one other thing in that regard. So, and I shared this on Twitter just because, and I'm not sure people understand what the point is. I took this right off the quote a couple of days ago on my Interactive Brokers account, and I want to illustrate why the market is dominated by very, very short time horizons, and why we have to adapt to that, and why there's money to be made with shorter horizons. How the market works, I'm not a fan of it, but if we're going to shift the focus of the market away from underlying business fundamentals to very short horizons, well, then let's do the very best we can to compete in that environment and produce returns. But just look at this. This was the bid and the offer and the amount of shares at those prices. So at $59.50 for Coke, there were 2,800 shares. That's called at the top of the book, best offer to sell. And then the bid to buy will always be lower than the offer to sell. Bid ask, and the bid to buy or ask, or the offer and the bid and the offer, 1,400 shares, right? So there's a 1 penny spread, and so the trades occur in sub-penny increments. But here's the key. This is a very liquid stock. KO trades 120,000 times a day, $900 million of stock a day. You can fill a trade pretty easily in Coke. Then you come over here to SH. As we realize, Coke is 257 billion in market cap. It's big, one of the great American consumer staple stocks. Then you come over to SH. SH has a 1 penny spread, but look at the shares at the bid and the offer. I mean, you add those up, it's 2 million shares at the bid and the ask. Well, which thing are you going to trade? Large institutions will trade this to make 3 pennies, because if you buy 1 million shares, it's 3 million pennies. And so if the market goes down a little bit, well, I just made 3 million pennies. And then I'm long SPY. If the market if that moves up a couple of pennies, do the same thing. Do that all day long. That is arbitrage. And it is absolutely dominating the market. That is how it works. That's not helpful to my longtime profession, public companies who are trying to create, economic value and use the equity market for capital formation. Doesn't work very well for it, and here's the perfect illustration. You know what SH is backed by? 5 swaps with JP Morgan, BNP Paribas, Societe Generale, Bank of America, and Citi. There's not even any assets. They're a 1-day swap where the banks promise to provide -1 times the performance of the S&P 500. That's how it works. Now, you guys may know a lot more about those instruments, but that's the mechanics, and those are the facts. And a lot of people do not understand that that is why it's occurring in the equity market. So, look, if there's that much money chasing short-term prices, well, then we have to, we have to be aware that that's what the market is doing. Let's see. Okay, so let me I want to make sure I don't miss anything. I'll go back after the fact, and sometimes I see that I have missed things. Yes. Now, are you talking about data? Yeah. Oh, thank you. Thank you, Ron. I appreciate that. I'll come back to that and see if I can sort that out. They charge for data. And Pam, I presume you're talking about Interactive Brokers. I'm willing to pay that cost so I have some greater insight into how my trades are handled. And another thing in there, notice this. Look at that. This is what really happens to a trade. You put in 300 shares of something, and it's getting wood chipped into all kinds of pieces. So this happened to LSCC. I put in 99 shares, 9 of them executed at Island, another 5 at Island. Why would they do that at 91.11? Wish I'd stayed longer, but I was concerned. I was happy to just take the gain. Now they could take that order, which originated from me, a natural person. And so as a natural person, instead of an algorithm, that trade becomes fungible. They can take 5 shares, very little capital commitment, and go price the exchange with that trade, turn right around at the same price. They bought it from me and sell it to somebody else, and the exchange will pay them for that trade. That's called a rebate. And there are billions and billions of dollars of rebates. So the SEC is all concerned about how we little guys are losing $1 billion. That's what they've calculated because of all these trades occurring at maybe subpar midpoint comparisons between the bid and the offer. Well, the exchanges are paying billions of dollars to the Citadels of the world and the Hudson River Tradings and Two Sigmas and Quant Labs and so on to set the prices. But that's fine. I'll tell you, they confuse busy with productive. They have their reasons. They want the exchanges on their side. They want the market to be uniform. They want everything to trade in the same spreads, in the same fashion. They would prefer that everything be the same price. A uniform market is to the SEC the desirable end goal. And I'm not a fan of that, because then what differentiates the market? How does it serve as a barometer about the health of the economy or businesses? But we can trade it, but you got to understand what's going on and why and what the purpose of the regulators is. So I thought it was important to share that. Now, we'll get into the meat of the matter here about, how to use all this stuff. I want to very quickly, and any questions, comments, jump in. If you say, I don't get any of that, go ahead, because I'll tell you, as I said, that NASDAQ stuff was they're just wading through. And I said, how is this helpful? The Buttonwood Agreement that created the NYC was 2 sentences. We'll charge a minimum commission, and we will give each other preference. Now there's a cap on fees and no preference. It's the exact opposite of what worked for 200 years. Anyway, ask questions if you like. I want to get us over to Edge because I want to talk very quickly about the BCD. Where's broad market sentiment? 5.5, still over 5, but it's coming down. I don't know where it's going to bottom. On a trend line, not yet. The interesting thing is the market's generally pretty healthy. This isn't great. This is the first time we've been over 50% of all trading volume. There's a slight short bias to the market. Yet a lot of stocks are closing above the midpoint. I can see that there is underlying buying by investors, buying the dip. They'll be right or wrong. I don't know. I look at this and say, this is a market that at some point it's going to catch up with us. This was the all-time high. I take it back. I said in the market desk note today, there was only one other time when it was higher. That's not true. It was higher right here, right as the market bottomed. And if you go back a little further, I think this is useful just to know, and these are all-time highs. You can look at the entire data set, and the highest that it has ever been, I got to go further, was right before the post-pandemic bottom in here. So this was the high. See that? See how high that short volume was? So Demand had a weak top right at options expirations, but supply was off the charts. Warning. That's how markets fall apart. That condition doesn't exist to the same degree as it did then, but this is, okay, you got 1, 2, here we are at 51%, 50.7%, 50.2. So we're running at those levels that tend to undermine the market. Do I think that will happen? I mean, I think there's a reasonable chance of it. And so you got to be aware of that. Broad sentiment, then you look at context. What's occurring right now? Options expirations. AM dated index futures expired today, noon Eastern time. Market might do fine into the close again. We'll see. People are unaware of the risk. So they do their thing. They run their models. I certainly think there's risk, and it's reflected in, if you look at divergence, you want low volatility divergence. It's stuff at 5 with declining supply. If you want momentum, it's demand and supply moving opposite directions. And look at that, 7 and 4. We got nothing. It's very limited. These are challenging conditions, and we should be aware of it. And how does that then affect what we do? Well, I think your time frame should be pretty short. Realize that there is a risk that the market will do things that you don't expect during this period of time because options are expiring. But important to know. And if you're not sure what I'm talking about, I'm going to pop over here and just look at this really quickly and point it out for you. You longtime folks, bear with me. I appreciate your patience as I repeat some things. So here, the expirations calendar. I think it's very important. There's a guy named Marko Kolanovic who's a strategist, I think, for J.P. Morgan, and he's very concerned about these 0 days to expiration options that are trading now. Maybe some of you folks are trading them. I don't trade those. These matter because they're the things used by very large scale money to protect against month-to-month movements. It's what the large institutions use, but we're almost $1 trillion of daily notional value in those short-term options. And I don't know, he thinks there's a risk of that destabilizing the market and reintroducing volatility. And how will we see that? Look, I think high short volume levels are reflective of that. I think they reflect hedging against an exposure to a market direction. And if those things hit a level of equilibrium, the market can tip over. There's got to be a spread for the market to maintain its footing. When spreads narrow and everything becomes the same, that's when markets fall apart. And it's because there's not two sides to a trade. So, we'll pay attention to that. Okay, that's BCD. Then I want to talk about something really quickly here. I'll pause in case there's a question, but I want to talk about something. I think James brought this up last time. How do you use all this information? Okay, that's an important question. It's, to me, pretty simple stuff. This is a simple platform. We're trading supply and demand, and we think about 3 things. What is the broad sentiment doing? Because it's reflective of the currents of the market, Fabi. There are BlackRock, Vanguard, and State Street. Go look at the 13Fs that just came out. They're coming out right now. They had to be out, I think, yesterday. And those firms dominate the top of the ownership list of almost every company, in fact, probably every company in the Russell 1000, which is 95% of market cap. So as that money goes, so goes the market. When it comes back into tech like it did in January, market does great, tech soars. When that stops, and I don't know when it will stop, March expirations are very important because they're quarterlies, and there are quarterly index rebalances, and there's going to be a disproportionate exposure to tech, all things being equal, into that. So that's one thing, Fabi. It's knowing what the money's doing, what's the calendar, because options reset, and there are hundreds of trillions of dollars of notional value. There's exposure, and it leads people to have to buy and sell things, particularly large banks, insurance companies, anybody who buys or sells volatility. Very important to know that. And then we trade divergence. That simple. If there's not a whole lot of information you need to know beyond that, we can rely on the machines to do a lot to help us. Okay, I'll come back to these other questions because I want to go to this point. So I think it was there were questions about this last time in the demo, and I didn't do a good job answering it. I kind of stumbled around and I didn't feel good about the answer I gave. I think it was James who said, Why is this? If we take pins as an example, you got rising demand, falling supply, and yet the stock went down. Now, there may have been extenuating circumstances. Maybe it reported results. This happens on occasion, but it is an outlier. But there is a problem here. I'll go back to the D, BCD. D is divergence. If there's not a divergence, there's trouble. Even here, the divergence broke down. They're going the same direction. That's not great. So it's hard to do that with the human mind, which is why I rely on the math here. You can do it yourself, but why not just let this thing do the work for you? It's going to find divergences of 1%, of one standard deviation, in effect, in everything, and it's going to give us stuff that has a reasonable chance of moving and that has strong demand and insufficient supply. Doesn't work perfectly, but most of the time, if we look back through the data, these things have worked very well, and I'm going to use them. Why would I go hunt around through thousands of securities when I can just look at these and I have just as good an opportunity to make a return in these as in anything else, but it's supported by math? You take a lot of the chance out of it. So you can go do your own. I mean, here's what you should do. If you are buying and doing your own research and coming up with stuff, let's say you love Tesla, well, just make sure that before you buy or sell it, that you think about what's the supply and demand. And Tesla is it's pretty extraordinary, right? This is where it took off. Strong demand all the way to 10, insufficient supply. See how that's divergence. And that creates movement in price. It slowed down here. That's where the price declined because supply jumped ahead. Then supply reverted to the mean, off the price went, and demand never wavered. It still hasn't wavered. And here's insufficient supply. Look, it's too high. It's 65% of the trading volume. Tesla's price is living on credit. That's what that means. There's a lot of borrowed stock behind it, which at some point will create a surge and a sudden drop. I don't know when it will come. It will hopefully get a signal from one side or the other. But if you own Tesla, watch those things. If you just choose to, you got your own basket that you like to trade, do this. Look at the supply demand equation. When they materially decline, change, if there's a convergence, then take your money out and wait for those conditions to improve. That alone will help you beat the market, no matter what your personal preference is in terms of what you like to buy or sell. It's the best thing going because it reflects everything the SEC has done and desires to have in place in the market. They want everything to trade between the national best bid to buy and offer to sell. They want a continuous auction. They want this whole thing to work, even though it's kind of full of artifice and trickery. Okay, well, we'll work with that. Another thing, I wanted to just notice how well these data work. Yeah, let me use THC as an example. We mentioned this on February 10th as here's a great drop in supply, strong demand. Even though demand has come down, prices continue to deliver because there's insufficient supply and momentum has been fine. Now, would I leave? No. As soon as one of these changes, this continues to decline, then like pins. The point with pins, Pinterest, was on. Let's go back and look at that. I'm jumping around, but I maybe you'll remember this. This was the point last week, and the question came up last week. That would have been the 9th. So the data that would have been available to us as traders would have been from the 8th. And you look at this demand hitting 10, supply, not great, but it did tick down day over day. What do you do? Right? What do you do? The price on this day dropped as we held the demo. In fact, somebody said, well, it's way down. It's down like 4% today. That's volatility. Should I buy that? Well, you could. You actually could. I don't like to buy falling demand, but we didn't know yet, right? So let's say you bought it. You say, well, I'm going to buy that because demand, as I know it, is at 10 and supply ticked down day over day. And then you look at it the next day on the 10th and you go, wow, demand's falling. Well, so is supply. Do you have to leave? You don't have to leave. If the whole market is still good, you could just wait for an exit point, but you'd be looking for one. That's what you would do. It's not like you have to do it right away. You get some warning. Is pins about to decline? Probably. Maybe it's doing it today. I haven't looked, but you get some advance warning. And I think the core takeaway is when everything is working to your advantage, you can have 5 or 10 days as a horizon. When you know that everything's peaked and beginning to deteriorate, shrink your time frames. You add in options expirations, be very quick to take gains. I hope that makes sense. Okay, those are the core things. Other than I want to talk a little bit about finding stocks and using some examples. But let me come back to the questions that you've asked. Andrew, short-term bottom. Well, a short-term to a true market bottom. It's very. You could go look at the whole data set, and this will tell you when you should reduce your. You could just use this to trade SPY, by the way. When do you reduce your exposure to it? Somebody said last week, should we be shorting the market? Well, I'm doing that a little bit with that hedge. I don't know enough about it to speak to it. I need time in the saddle. But here's a bottom. When the whole broad sentiment drops below the green line, 100% of the time in the data set, that has been a signal to increase exposure. Might be short term to the equity market. When it goes over the red line, particularly at about 6.5, 100% of the time, the market has declined within the next options expirations to 2 options expirations periods. So then you have to be a little more tactical. And if you were trading SPY, you'd say, well, look at all those great gains. Very volatile, though. That's difficult. So you could avoid that. I mean, you could shift from being exposed to that, just trade momentum, trade low volatility, and wait for this to bottom. This thing is not bottom. What happens if it gets to 5.0? Well, it's not a great entry point. It's not like this. I wouldn't go shoving a bunch of money into the market unless you get below the green line. And you can expand this out to see more of it. Yeah, question?
So, Tim, I have another great example for you on earnings. If you take a look at Disney.
Okay.
They
Very good
earnings.
To hear you. How's Hawaii?
I've been in Maui this whole time, so I'm still in Maui.
Nice. Yeah,
yes.
Good for you. I prefer to. Well, no, I mean, we got good, but I'd swap places with you anytime that you want.
I'm having dinner at Cane and Canoe tonight, so you're welcome to join me.
I know it. I have been there. It's a great place.
But if you look at Disney, it was supply was through the roof. It popped the next morning on earnings, and that's when I jumped in because the data was telling you that the morning pop you got was not going to hold, and simply because there was just way too much supply. It's a great example. If you put it on a different time frame, you can actually see it even looks worse. Historically.
I'm going to go. Okay. Oh, there you go. So what Barry means is this: there's a huge oversupply, and you look at the trailing data, it's higher than it's been in the whole 90-day period, and you could probably back it up more. But again, here's that launch pad: rising demand, falling supply. That is a slingshot, right? That's great. That's a good example. So you're probably short this now.
I was short a little bit going into earnings, waited because I wanted to wait to see what the market was going to do, and then when it popped in the morning right at the open, that's when I went short.
Yep.
Let it come down, $8 and got out.
There you go. That's really good. Good example. Thank you for that. Let's see. How short a time frame are you talking about, Alex? If I'll use yesterday as an example. I was concerned because it was VIX expirations. I'm very wary. As I've said before, the 2 of my 3 bad mistakes trading things came by trading into options expirations, and I got clocked. So I'm very careful about that. You have a choice. I know risk is higher, so if I don't want that risk, I skip trading during options expirations. But here's my point. So LSCC yesterday, I bought it early, and but when I got my close, it was like 1.8% return. I left, and I could have gotten a 3.5% return, which is exactly what volatility indicated, right? If you look at LSCC in a portfolio, I think that's what it was. It'll be a 5-day average. My time frame, Alex, is very short here. When everything's surging, my time frame will be longer. because when everything's pulling your direction, well, you might as well stay so long as the data continue to support the trade, and you don't have a breakdown in supply or demand. But looking at the volatility here, and I could, if I just trusted the math, it's 4.4 today, but I think it was in the threes yesterday. I could have said, well, if it's up 2% and now everything's turned around in the market, what's the chance that it goes up 3.5, maybe even a little more? Well, statistically very high, because that's what that number's telling us. It's telling us what traders have done. So it gives us a little different, additional information. But I was gun shy, Alex, and that's my point. I'm quick to take gains, not chances. Even with the recall today in Tesla, right? It's often the point, Pam, that we have all these headlines. Headlines don't make decisions. Algorithms do. 98% of orders run through algorithms, which are probably further managed by order management and execution management systems. So rational information is an input and can change the parameters, but the reality is machines are executing trades. So unless there's a supply demand breakdown, well, the probability is the price will continue to reflect that supply demand condition, which is normally time frame to buy at the open. It depends. With momentum, yeah, as I've said before, love to buy momentum stuff when it's down half the volatility in an environment where I'm very comfortable staying for a number of days, because there's a much higher probability of producing a return. During expirations, I bought it right out of the gate. It was flat right out of the gate, and I thought, well, if it's going to rise, I want to be in early. So it depends on that circumstance, but that's how I think about it. Gary, I've had considered the platform, love it. Thank you very much. There's a downgrade. It happens, but you should ride those out, probably. I mean, if you look at it, probably they cause a short-term reaction by machines that it does not change supply and demand. If supply and demand haven't changed, stick with it. Do you typically buy at the open or only? Again, it depends. I know machines are setting prices at the beginning. That is a fact. The entire market is priced by proprietary traders. But look, they know this in a shorter increment, the same things we do. We are looking days out, but they're looking at supply demand too. They're looking at the tick data. So if we're looking at momentum stocks, we might have a good entry at the beginning. Maybe it's an hour in where the stock goes up and then it pulls back. I've done that repeatedly. I know that machines are chasing the price away from people buying it. And then as soon as people stop buying, the price retreats. There's another opportunity to add to your position. So, there's not a perfect answer. There's not an absolute objective answer. It certainly depends on what the broad market is doing. The ideal trade to me, and we've got a couple of them today in momentum, where you've got stocks that are down a little bit, but have very good supply demand divergence, like Fortinet. I look at Fortinet and say, well, what's the probability that into Friday expirations, based on this demand and this supply, that it's up? Well, it's pretty high. Not absolute, because of this slight uptick in supply here. It's a one-day downtrend. It's something we isolate for, but good demand, one-day downtrend, probably. I looked at them and said, of the lot, this was the best. And all I'm talking about is which has the best divergence. That's all I'm thinking about. Demand's pretty solid. Look at that sharp drop in supply. Well, the probability that produces some kind of some portion of that, is very mathematically high. And, I hope it finishes fine, but that's what I'm looking for. And those are very short time horizons in options expirations, or where the whole market is beginning to deteriorate. If you look at the supply demand equation in the market, look, it's not great. Look at airlines and cruise ships. Not good. Communication services, woeful. Consumer discretionary, woeful. Consumer staples, woeful. That's going to catch up to the market, because you put these together. How 12% of the market? I mean, each of these are about 12, thereabouts, I think. So then if you add in financials, not great. Look at that. Well, they're another, they're close to that. Then you throw in tech at 26 or 7%. And that's woeful. It's not as bad, but it's deteriorating. I wouldn't call that woeful. I'd say not great. Now you got 65% of the market looks like it's got falling demand and rising supply. Now it can all work out. Those aren't great things. Short horizon. That's how it should be. Okay, take a couple more questions and we'll wrap up so I don't keep you too long. Who's got it? Barry, you've got a question. Barry Bailey, you've got a question. I mean, you got to fill in for Steve, right? We don't have the Hicks rule present.
Tim, one thing that's always baffled me is, you do the 99 share buys and sells,
Yep.
and the rule is 100 shares will get executed. So why do you do 99? Just curious. It's just since you forced me to ask, I had to ask it.
Right. Call it a superstition. I don't want to look like dumb money, so retail traders tend to buy in round lots, and 68 or 9% of orders, believe it or not, are odd lots. They are not 100 shares. And if so an odd lot is less than 100 shares. But if you actually look at what algorithms execute, and we do that, so we consume that data, there are almost no round lots. They're buying amounts of money or amounts of the supply that's in the market, and they'll take it all. And so rather than just stand out like a dumb sore thumb in 100 share increments, I buy 99. I know it's at the market, it's going to get filled. And if there's a spread of 20 cents, as you know, then I'll bump in between the bid and the offer and put in a marketable limit order. If it doesn't get filled in 10 seconds, I cancel it, because I know that the market is not moving in my direction. But that's how I think about it.
When you try to bridge between the bid and the ask, somewhere in the spread, generally, where do you go for when you're doing a buy? Say there's a 10-cent spread. I know you normally don't do that big of a spread, but it's 10 cents for an example. Where would you go?
Well, let's look at it. So if I wanted to buy this and I want to do so here's the spread, right? So the spread is actually 13 cents there. So there's a 13 cent. That's acceptable to me. I would just come down here and put in a market order. But if you're gonna put in a limit order, and the machine is suggesting 143.04, that's at the top of this. I'm not doing that, right? So I'm gonna put in 142, and I know it's 91. How about 94? I mean, I want to get the best possible price, right? And is a machine willing to cross that spread? 99 times out of 100, it probably will, particularly if I drop my trade to 50 shares. I've cut the risk in half for a machine to cross the spread to make a half a penny. And so that's what I'll do. And you could fill a smaller amount. $7,000 is a lot easier for an algorithmic trader, which is very carefully managing exposure, to swallow than is $14,000. $14,000 is a lot. I know I'm taking a chance when I try to buy a net at the market 99 shares, because I'm going to get a worse price. But if I think the price is moving, then I don't care. It just, depends. Yeah.
Interesting. Thank you.
Okay, you bet. All right. Is that a good spot to end for this week? That's enough market structure. Let me see. Can you look at CVS? Okay, Andrew, let me do that. Yes, but then you can't sell. True, Pam. I know. I get that. There are other considerations, and I'm not doing that. I'm not selling or buying volatility per se. So you have to factor that into the equation. No question. Chart default time frame is 3 months. I like to look at 10, 30 days for latest sentiment. Is the data reliable? Yeah. I mean, I look. This is what I use. I always use the quick search view. So maybe I'm just going to do this. I look at this because everything's continuously changing. So that's a pretty good read. It will give you what happened before and where everything is, so I like that read. That's what will influence my decision. Then can you look at CVS? Okay, we'll wrap with that, CVS. So, right, there's no divergence. Can demand overcome a rise in supply? Yes. And the supply is not very high. It's at 41%. That's well below the 50.2% that we see in broad sentiment. But this and this, I won't buy that. I'm going to go find something else. I mean, could you make a case that this is telling us that people are buying puts and calls? Yeah, you could. Into Friday expirations, I think that this is what it reflects. And right now it's a tug of war, and we don't know who's going to win it. But to me, that's too risky. I would much prefer, if I'm going to buy something like a CVS, which is generally a low volatility stock. I mean, everything gets blended. I'm much happier coming and looking at like a Kimberly Clark. To me, that's pretty darn good. It's a little high too, it's like, but 42%, in this market, that's a pretty good stock. I would prefer that over CVS. Okay, you guys, I'm going to let you go and we'll do this again next week. Thanks again. Thank you for joining. Thanks for all the questions. Like to see those. All right. Enjoy the weekend, the long weekend. Market is closed on Monday, President's Day. So all the riffraff will be on the slopes out here. Enjoy, you guys. Thanks much.